Let's talk about the impact of volatility on your portfolio and net worth, because it is massive and no one talks about or knows about this. We all assume, oh, the stock market has returned, 10 to 11% average over the last few years, so I'm just going to keep compounding my investing. Not so. Check out this graph here on the right. On the right is a graph that took the 30 best years of the stock market from 1970 to 1999, where the average return was 10.85%. And let's say in the year 1970, you put $1 million in the stock market with a return of nearly 11% each year, and you took out $100,000 because you wanted to live off your $1 million. Okay, so what happens is with a return, a constant return of 11%, at the end of 1999, you will have pulled out a lot of money to live on. You still have $600,000 left. That's a good deal. Awesome. Any day of the week, that is a good return and a great way to live off of your retirement fund, okay? But here's what actually would have happened. In the next slide, with high volatility, is the same situation, but in the second column, the earnings rate, it has the actual returns of the stock market in that same 30-year period that on average returned at 11.85%. In actuality, if you were to have done that in actual stock market with actual volatility, you will have run out of money in 10 years later, because you're taking out $100,000 a year and the volatility just decimated your portfolio. So if you look at, for example, 1974, it was a giant loss of 30%, but then in 1980 it was a huge jump of 26%. And that volatility just crushes your portfolio. The reason I bring this up is the average returns are not nearly as important as the level of volatility. So in other words, a 7% average annual return without any volatility is likely to return a higher return because it's truly compounded than something with an average return of, say, 20% that gyrates wildly. And this is yet another argument why multifamily is actually more attractive than the stock market, because it's much less volatile. Okay, our average annual returns, we really look for around 15% average annual return. That includes cash flow distributions, which the stock market doesn't have either. Okay, and then the profit at the very end. And that 15% is real, right? Meaning that you put $100,000 in a multifamily investment at a 15% average annual return of that money, you're doubling your money in 5 years. That's just the way the math works. So really pay attention to whatever you're investing in, stock market, oil, precious metals, or anything like that. Look at the volatility. Don't just look at the average annual return. So that's the importance of looking at the volatility of whatever you're investing in.